You wake up on Friday, January 30th, 2026. Check your portfolio and watch in real time as silver, the metal that had been making people millionaires, just 24 hours earlier, crashes 30% in a single trading session. It's the worst day since 1980. Billions of dollars evaporating, fortunes made and lost in hours. This isn't some obscure penny stock we're talking about. This is silver, one of humanity's oldest forms of money, critical industrial metal powering our clean energy revolution. And it just experienced one of the most violent price swings in modern commodity history. But here's what makes this story absolutely fascinating. The crash came immediately after the most spectacular rally silver has ever seen. We're talking about a metal that surged over 240% in just 12 months, breaking through $100 per ounce for the first time in history, touching highs above $120, and creating a genuine mania that had everyone from Wall Street analysts to social media influencers screaming silver to $500. So what really happened? How did we go from euphoria to panic in less than 48 hours? And most importantly, what does this mean for investors, for industry, and for the future of silver? Today, we're going deep. Buckle up. To understand the crash, we first need to understand the rally. And to understand the rally, we need to go back to 2021. For 5 consecutive years, 2021 through 2025, the global silver market ran in deficit.
I think about what that means. More silver was being consumed than was being produced.
Every single year, the cumulative shortfall, nearly 820 million ounces. It's almost equivalent to an entire year of global mine production, just gone. Where did it go? Let me paint you a picture. Walk outside and look at the nearest solar panel. Inside that panel is about 20 grams of silver. Now multiply that by the explosive growth in solar installations worldwide. In 2025 alone, solar manufacturers consumed somewhere between 200 and 250 million ounces of silver. That's approaching 25% of total global demand from just one sector. But solar is just the beginning. Electric vehicles need silver, about 25 to 50 grams per car for sensors, wiring, and battery components. As EV production skyrocketed, so did silver consumption. Then there's 5G infrastructure, semiconductors, data centers, medical devices, and even nuclear reactor control rods. This is what makes silver unique. Unlike gold, which is primarily an investment asset and store of value, silver is a workhorse. Industrial demand represents roughly 60% of total consumption. Silver is the best conductor of electricity known to mankind. It's irreplaceable in high-tech applications. You can't just swap it out for copper when prices get high, at least not icily, and not without compromising performance. Now, here's where our story shifts into high gear. In December 2025, China dropped a bombshell. Starting January 1, 2026, the country would impose strict licensing requirements on silver exports. Only companies producing at least 80 tons of silver annually, with $30 million in credit lines, would be eligible to export. Why does this matter so much? Because China controls an estimated 60 to 70% of global refined silver supply. It's not just mining. China takes silver ore from around the world, refines it, and exports it back out. Suddenly, thousands of smaller exporters were cut out of the international market overnight. This wasn't just about supply and demand anymore. This was geopolitics, resource nationalism, strategic control over a critical material that the United States had already designated as a critical mineral. Tesla CEO Elon Musk weighed in over the weekend before New Year's. Silver is needed in many industrial processes, posted. Flagging China's restrictions is not good. The market's reaction was immediate and violent, but not in the direction you might think. Silver didn't crash on the China news. It exploded upward. The metal had already been on a tear throughout 2025, rising from around $28 an ounce at the start of the year. By September, it hit $44, the highest level in over a decade. Then came the fourth quarter. In late December, silver crossed $70 for the first time in history, and $75. Then, on December 28, 2025, it breached $80, hitting an all-time high of $83.62. But that was just the warm-up act. As we rolled into January 2026, the mania intensified. Silver blew through $90, Then $100, a psychological barrier that many thought would take years to breach. The momentum was unstoppable. By mid-January, spot silver was trading above $110. Some exchanges saw prices touch $113, even briefly $120. The numbers were staggering. From a year prior, silver had gained 240%. In January alone, up 54%. Every hedge fund, every retail trader, every social media investing guru was talking about silver. The FOMO, fear of missing out, was palpable. Robert Kiyosaki, the Rich Dad, Poor Dad author, was posting almost daily predictions. Silver breaks $80,200 next, he wrote on December 29th. Days earlier, he'd predicted silver could hit $500 within a year. But even as he celebrated, Kiyosaki added a warning that most people ignored. If you are planning on investing in silver, be patient. Wait for a crash, then go. Or no, I believe silver. FOMO, fear of missing out mania, crash is coming. Looking back, the warning signs were everywhere. But in the heat of the moment, when prices are going parabolic and everyone you know is making money, who wants to listen to warnings? The technical indicators were screaming. The 14-day Relative Strength Index, RSI, stayed above 74 weeks, a clear signal that the market was overbought. When RSI stays elevated that long, a correction isn't just likely, it's inevitable. The COMEX futures market told another story. Net speculative long positions exceeded 60,000 contracts near 5-year highs. Translation: the market was crowded, really crowded. Too many traders betting the same direction, all trying to squeeze through the same exit door. Global silver ETFs saw over 7,200 tons of inflows in 2025, pushing holdings to record levels. Investment demand was strong, sure, but it was also creating a tinderbox. The moment sentiment shifted, all that hot money could reverse direction just as fast as it flowed in. But perhaps the biggest red flag was this: prices had completely disconnected from physical market fundamentals. Shanghai premiums, the amount buyers were willing to pay above spot price for physical silver, exceeded $8 per ounce. That's a sign of speculation, not genuine shortage. When financial markets are trading at massive premiums to physical delivery, you're not looking at industrial buying. You're looking at a speculative bubble. Even industrial buyers were pulling back. At $100 plus per ounce, manufacturers in the solar industry started exploring alternatives. LONGi Green Energy Technology, one of China's largest solar cell manufacturers, announced they were replacing silver with base metals to reduce costs. When your primary customer base starts looking for the exit, you've got a problem. Thursday, January 29th, 2026. Gold hit an all-time high of $5,595 per ounce. Silver was trading near $120. The precious metals complex was in full euphoria mode. Investors were celebrating. The permabulls were vindicated. We told you so, echoed across social media. 24 hours later, the entire market was in freefall. Friday, January 30th started with rumors. President Donald Trump was reportedly about to announce his nominee for Federal Reserve Chair, Kevin Warsh. For those unfamiliar, Warsh is considered a monetary hawk, someone likely to prioritize inflation control and maintain tighter monetary conditions. The polar opposite of what precious metals bulls wanted to hear. The announcement came. The dollar spiked, and the selling began. But what started as profit-taking quickly turned into something much more sinister. A full-scale capitulation event. By the close of trading Friday, spot silver had crashed 28% to $83.45 an ounce. Have you ever seen an asset just plummet, seemingly out of nowhere? That's what can happen in the silver market. And today, we were going to peel back the curtain on one of the most dramatic events in finance, a silver market crash. We'll explore the mechanics behind these terrifying price drops, key players involved, and what it all means for the future of this fascinating metal. So what exactly happens when silver nosedives? It often starts with something called a margin call. Imagine you've bought silver on leverage, meaning you borrowed money to increase your position. You only put up a small amount of your own cash, called margin. If the price of silver starts to fall, the value of your position shrinks, and your broker gets nervous. They issue a margin call, demanding you add more cash to your account to cover the potential losses. Now here's where it gets brutal. Many traders don't have that extra cash lying around. So what do they have to do? They're forced to sell their silver positions to meet the margin call. This is forced selling, and it creates a vicious cycle. The more people are forced to sell, the more the price of silver drops. A lower price triggers even more margin calls for other traders, forcing them to sell too. This cascade of selling is what traders call a death spiral. It feeds on itself, pushing the price down faster and faster. The problem gets even worse because the silver market is notoriously thin. This doesn't mean it's unimportant, but that compared to markets like stocks or bonds, there are fewer buyers and sellers at any given moment. So, when a wave of forced selling hits, there aren't enough buyers to absorb all that silver. It's like trying to drain a swimming pool through a tiny straw. The sellers have to slash their prices dramatically just to find a buyer, which accelerates the crash. In today's high-tech world, this entire process is amplified by algorithmic trading. High-frequency trading bots are programmed to react to price movements in milliseconds. When they detect the initial drop and the start of the selling pressure, they can unleash a torrent of sell orders far faster than any human could. These algorithms don't have emotions, they just follow their code. If the code says sell, when the price drops by X%, they will sell, adding massive fuel to the fire and turning a dip into a full-blown collapse. Another major factor that often plays a role is the US dollar. Silver, like most commodities, is priced in US dollars globally. So, when the dollar gets stronger, it takes fewer dollars to buy an ounce of silver. This makes silver more expensive for buyers using other currencies, which reduces demand and puts downward pressure on the price. A sudden surge in the US dollar can act as a powerful headwind for silver, sometimes being the initial trigger that sets off the whole chain reaction of margin calls and forced selling. And when silver crashes, it rarely goes down alone. It tends to drag other precious metals along with it, especially gold. While gold is often seen as the more stable, senior precious metal, silver is its more volatile, speculative little brother. They often move in the same direction, so a panic in the silver market can spook investors in gold, platinum, and palladium. It's causing a wider ripple effect across the entire precious metals complex. Investors see the carnage in silver and think, what if gold is next? And start selling as a precaution. So who or what is to blame for these crashes? The debate is fierce. One popular theory is manipulation. Some argue that large banks or institutional players, it's often called the bullion banks, intentionally drive the price down. They might do this by dumping huge amounts of paper contracts like futures or options onto the market. This creates the illusion of a massive supply of silver, crushing the price and allowing them to profit from short positions or buy physical silver on the cheap. Proponents of this view point to the massive difference between the amount of paper silver traded and the actual physical silver available as evidence. On the other side of the argument is speculation. This view holds that crashes are simply the result of speculative bubbles bursting. In the lead-up to a crash, you often see a frenzy of buying, driven by hype and the fear of missing out. New, inexperienced investors pile in, often using leverage, pushing the price to unsustainable levels. When the bubble finally pops, the ensuing panic and forced selling are just a natural, albeit painful, market correction. According to this perspective, it's not a conspiracy, but rather the predictable outcome of human greed and fear. This brings us to the two competing visions for silver's future, the bear case versus the bull case. The bears look at this history of volatility and see a speculator's trap. They point to the paper market manipulation, the flash crashes, and the fact that silver has, at times, failed to act as a reliable store of value or inflation hedge. They argue that as long as the paper market dwarfs the physical market, silver's price will remain at the mercy of big financial players and speculative whims, making it a risky bet. However, the bulls see a completely different picture. They focus on the underlying supply and demand fundamentals. On the demand side, silver is a critical industrial metal. It's essential for solar panels, electric vehicles, 5G technology, and countless other electronics. As the world transitions to green energy and becomes more technologically advanced, the industrial demand for silver is set to explode. They argue that this demand is real, tangible, and growing every year. On the supply side, the bulls point out that easily accessible silver from mines is becoming scarcer. Mining grades are declining, and new discoveries are rare. For years, there has been a structural deficit. meaning we use more silver than we mine annually. This deficit has been filled by above-ground stockpiles, but those stockpiles are finite. The bulls believe we are rapidly approaching a point where industrial demand will overwhelm the available supply. When that happens, they argue, the price will have to rise dramatically regardless of what happens in the paper market. A manufacturer that needs silver to build solar panels can't use a paper contract. They need the real physical metal. At some point, the disconnect between the paper price and the physical reality will have to be reconciled. The bulls believe this will lead to a massive repricing of silver, where its true value as both a monetary and an essential industrial metal is finally recognized. So what we have is a classic showdown. Is silver a manipulated paper game destined for volatility, as the bears suggest? Or is it a fundamentally undervalued commodity on the verge of a historic supply squeeze, as the bulls believe? The truth is, the silver market is a complex arena where all these forces, margin calls, gabarithms, the dollar, manipulation theories, and real-world fundamentals are constantly at play. Understanding these dynamics is key to navigating its turbulent waters. Thank you so much for watching. If you found this breakdown helpful, please hit that like button and subscribe for more deep dives into the world of finance. Let me know in the comments which side you're on, the bear or the bull case for silver. See you in the next video. Where do we go from here? As of early February 2026, silver has stabilized somewhat in the $80 to $90 range, still dramatically higher than where it started 2025, but well off the January highs. Technical analysts are watching several key levels. $93, primary support. This was the January 14th peak before the final parabolic move. If silver holds here, the bull case remains intact. $80, secondary support. The late December 2025 highs, breaking below here would be concerning for bulls. $70 to $75, the critical zone. This area represents the 50-day exponential moving average and strong psychological support. A sustained break below this level would signal that the correction could go much deeper. Most analysts agree that the fundamentals support silver prices significantly higher than the pre-RE 2025 levels of $28.30. But how much higher? That's where consensus breaks down. Conservative estimates put fair values somewhere in the $50 to $70 range based on industrial demand and supply constraints. Aggressive bulls still see $150 to $200 as achievable if the supply situation deteriorates further and industrial demand continues growing. Bears like Kalanovic think we're headed back to $50 or lower once the speculative froth fully clears. Who's right? Honestly, nobody knows. Anyone who claims they do with certainty is selling you something. Conclusion: the bigger picture. Let's step back and think about what this entire episode reveals about modern markets. First, speculation can overwhelm fundamentals in the short term. Silver had legitimate supply-demand issues. But when FOMO took over, prices disconnected completely from what industrial users were willing to pay. Second, leverage amplifies everything. The margin expansion and forced liquidations turned what might have been a 10 to 15% correction into a 30% crash. Leverage cuts both ways. It magnifies gains on the way up and losses on the way down. Third, market structure matters. Silver's thin liquidity made it vulnerable to cascading sell-offs once momentum reversed. In deeper, more liquid markets, crashes tend to be less violent. Fourth, geopolitics is increasingly driving commodity markets. China's export restrictions weren't about economics, they were about strategic control. As great power competition intensifies, expect more of this. Fifth, the energy transition is real, and it's materially changing commodity demand. Whether silver hits $200 or falls to $50, the underlying trend toward electrification and renewables is undeniable.